Coca-Cola, the brand is everywhere, right? It's so familiar, it's kind of like part of the furniture of the world. But have you ever really stopped and thought about just how massive this whole operation is? Like, how on earth does one company get its drinks into the hands of billions of people every single day? Well, today we're going to peek inside Coca-Cola's global machine to see how it really works.
All right, let's just start with a number that is, honestly, it's kind of hard to wrap your head around. 2.2 billion. That's how many servings of Coke products are consumed every single day. We're talking across more than 200 countries here. To put that into perspective for you, that's like over a quarter of the entire planet having a Coke product every single day. The scale is just, wow, it's staggering.
And this slide right here really just puts that journey into perspective. Look at this. It all started back in 1886, right? A single pharmacy in Atlanta. And they were selling about 9 drinks a day. 9. Now let's jump to today, and that number is over 2 billion. That's not just growth, you guys. That is a completely different universe of scale.
So, the big question is, how is that even possible? How does a company pull off that kind of global saturation? Well, the answer isn't some kind of magic trick, it's a machine. A very specific, incredibly powerful, and frankly, brilliantly designed system that we're about to break down for you.
Okay, so the very first thing you need to understand about Coca-Cola is what they call the Coca-Cola system. This is their core operating model, and it's built on an idea that kind of sounds like a contradiction, being a massive global business that actually operates on a local level.
And here's the key. When you picture Coca-Cola, don't imagine this one single giant corporation doing everything from the top down. That's just not how it works. The real secret sauce, the thing that makes it all possible, is this huge network of local partners. This decentralized setup is the absolute foundation of their entire global empire.
This slide breaks it down perfectly. So on one side, you've got the Coca-Cola Company itself. Think of them as the brand guardians, right? They create that top secret concentrate, they own all the different brands you know, and they're the ones behind those big global marketing campaigns. But then on the other side, you have hundreds of local bottling partners. These are totally separate companies that do all the heavy lifting right there on the ground, manufacturing the drinks, packaging them, and getting them to your local store.
So, if you follow the journey of a single can of Coke, it looks something like this. The Coca-Cola Company makes the syrup and creates all that marketing magic. Then they sell that concentrate to a local bottler. That bottler adds the water, the sweeteners, puts it all in a can or a bottle, and then uses their deep local knowledge and distribution network to get it onto the shelf of your local store, where you buy it. It's the perfect blend, global scale, but with local execution.
All right, so if that whole system is the body of the machine, then what's the engine that's actually driving it forward? Well, the company has a name for it, the top-line flywheel. It's their big strategy, and it's designed to create continuous and even accelerating growth. Let's dig into it. So, this flywheel has 4 key parts that all push on each other. And you know how a real flywheel works, right? Once you get it spinning, it starts building its own momentum. It's the same idea here. The 4 parts are marketing, innovation, something called revenue growth management. We'll get to that. And finally, integrated execution. Each piece gives the next one a push, making the whole thing spin faster and faster. First up, marketing. Coca-Cola knows, they really know, that the next generation of customers lives online. That's exactly why they're shifting so hard to a digital-first model. Check this out. Their digital media spend has more than doubled in just 5 years. And they're not just buying banner ads either. They're building dedicated digital content hubs and even using generative AI to create ads. It's all about meeting younger consumers right where they are. Next on the flywheel is innovation. And I want to be clear, this is about way more than just launching a new flavor of Coke. Their strategy is much broader than that. Yeah, it includes creating totally new products, but it's also about innovating in packaging. Think about those super popular mini cans, and even in the equipment, like the high-tech coolers you see in stores. Okay, the third component has a name that sounds like total corporate jargon, Revenue Growth Management, or RGM. But stick with me, because the idea behind it is actually super simple and really powerful. It's basically the art and science of making sure they're selling the right product in the right package at the right price for any given situation. Whether that's a single ice-cold can at a corner store or a big multi-pack at the supermarket, all priced perfectly for that moment. And the final piece of the puzzle, the thing that makes the whole flywheel spin, is integrated execution. This is where that partnership with the bottlers is absolutely everything. It's the huge real-world logistical mission of making sure a cold Coke is always within arm's reach in roughly 33 million retail outlets around the globe. Just let that number sink in for a second. 33 million. So, we've got the system and we've got the flywheel. But does this big, complex machine actually work? Does it deliver? Let's turn to the numbers and see how this whole strategy really pays off.
Now, this chart shows a key metric. It's called comparable operating margin. I know, it sounds super complicated, but it's basically just a measure of how efficient the company is. For every dollar they make in sales, how much do they actually get to keep as profit before things like taxes? And as you can plainly see, that number is going up. The machine isn't just running, it's getting more efficient and more profitable year after year.
And you don't have to take my word for it. The company tells us exactly why in their own financial reports. They say their margin is expanding for two main reasons. They're growing revenue organically, which is just a fancy way of saying the flywheel is working, and they're managing their costs really well. It's a textbook sign of a healthy, well-oiled machine. So here's the big takeaway. You've got this incredibly clever partnership-based system that gives them global reach with local smarts. Then you have the four-part growth flywheel acting as the engine, constantly pushing things forward. And when you put those two things together, what do you get? You get more than just a famous soda. You get a machine that delivers consistent, powerful, and measurable financial success.
Which brings us to one final lingering thought. Coca-Cola has been around for over 138 years, and they've been constantly tweaking and improving this machine. So the question we're left with is this. In a world where tastes are always changing and new challenges are popping up all the time, is this incredible growth machine really built to last forever?
All right, let's talk Coca-Cola. When they drop an earnings report, you see headlines flying everywhere. So in this explainer, we're going to cut right through all that noise. We'll unpack the numbers and figure out what's really going on with the company. Okay, let's just dive right into the heart of it. Check this out. In Q4, you see two numbers that they don't seem to make any sense together. On one side, operating income is down a whopping 32%. Yikes! But then, right next to it, comparable operating income is up 13%. So what gives? This is the mystery we're here to solve. Right? So how can both of these things be true? Is Coke struggling or is it thriving? And the crazy thing is, the answer's kind of yes to both. Figuring out why is how we're going to crack the code on this whole report. Okay, so to get to the bottom of this, we've got to learn a little bit of the lingo. We need to understand the difference between something called GAAP and non-GAAP. First up, we have GAAP. That stands for Generally Accepted Accounting Principles. You can just think of it as the official by-the-book rulebook for how companies in the US have to report their finances. It's super strict, super standardized. It's the official story, the good, the bad, and the ugly. And then you've got non-GAAP. This is more like the company's preferred version of the story. They take those official GAAP numbers and, well, they adjust them. They'll pull out certain things they say are one-time events or aren't part of the main business. The whole idea is to show you what they see as the underlying performance. Here's a great way to think about it. It's kind of like selling a house. The total profit you make, that's your GAAP number. It includes all the one-time costs, like, say, the brand new roof you had to install. But the increase in the house's value over time, that's more like the non-GAAP number. It tells you about the health of the market, separate from that one-time repair. See? Both numbers are true. They just tell you different things. And look, this isn't some shady accounting trick. Companies are totally upfront about this. Coca-Cola literally says it right in their report. They believe these adjusted, non-GAAP numbers give investors a more meaningful look at how the underlying business is actually doing day in and day out. All right, now that we've got our financial lingo down, let's go back to that scary negative number. It's time to dig into the official GAAP story. So the big thing to know is that the official number was pulled way, way down by this one massive item. We're talking about a $960 million charge. That single thing, that's the culprit behind that big 32% drop we saw. But what even is that? Well, it's something called a non-cash impairment charge. And the non-cash part is super important. This wasn't money flying out of their bank account. It's basically an accounting move. The company is officially saying, hey, on our books, we think the Body Armor brand is worth less now than we thought it was before. Which, makes you wonder, why would they do that? I mean, they spent billions on Body Armor. Why would they suddenly say it's worth less? Well, the report lays out a few reasons. For one, they're expecting the whole sports drink category to grow a bit slower than they originally thought. They're also admitting that the competition is getting really intense. And finally, It sounds like they're getting a little more focused with their plans for Body Armor's rollout. Basically, they're just being more realistic.
And this chart, wow, it really puts it into perspective. You can see how the body armor charge, which is the main part of those items impacting comparability, just takes a huge bite out of the final official profit margin. It's just like that new roof in our house analogy, a big one-time hit that drags the final number down.
Okay, so that's the official story, the Gap story, all about that big one-time hit. Now let's flip the coin and look at the other story, the one the non-Gap numbers tell us when we take that write-down out of the equation.
Just look at the revenue growth for the whole year. The difference is pretty wild. The official reported growth was 2%. But when you look at the organic growth, that's the non-GAAP number, it's actually 5%. That is more than double the official figure. Pretty big difference, right?
And this wasn't just a fluke. This healthier growth comes down to two main things. The core business was just growing really well organically, and the company did a good job keeping its costs under control. Actually, it worked so well that the underlying profitability of the business got a real boost. We're talking an expansion of 252 basis points. Now, that just means their profit margin grew by 2.52%. To put it simply, for every dollar they're making in sales, more of it is turning into actual profit. That's a healthy sign. So we've seen the Gap story and the non-Gap story. Now let's put it all together. What's the big picture here? This table really sums it up perfectly. On one side, you have the Gap story. The headline is Operating Income Got Hammered, and the reason is that huge Body Armor write-down. On the other side, you have the non-Gap story. The headline is Core Business is Looking Healthy, and the reason is solid organic growth and cost control. See, they're not fighting each other. One is about a big accounting event, and the other is about the day-to-day health of the business.
So here's the final verdict. When you look past the headlines, Coca-Cola's main business had a really solid year. All that underlying strength was just, well, it was temporarily hidden in the official numbers because of that big accounting adjustment on an acquisition they made a while back. And all this leaves us with a really fascinating question for the future, doesn't it? Their core business is growing strong, but this big, expensive acquisition seems to be struggling a bit. So what does that mean for their strategy? Do they stick to what they know and double down on their classic brands? Or do they keep hunting for that next big thing? Now that's the real story to watch.